Understanding Jobless Recovery, a comprehensive overview. What is jobless recovery? A jobless recovery refers to a unique economic phenomenon where a country emerges from a recession and experiences growth, yet the unemployment rate remains stagnant or may even increase. This scenario presents a paradox wherein gross domestic product, GDP, and corporate profits rebound, but jobs remain scarce, leading to a disconnect between the health of the economy and the labor market. Key takeaways. A jobless recovery characterized by economic growth without an accompanying decrease in unemployment is often driven by increased automation and outsourcing. Companies may decide not to rehire laid-off workers, opting instead for technology and lower-cost labor to enhance efficiency and reduce costs. A key indicator of jobless recovery is when the unemployment rate does not correlate with rising GDP figures. The mechanisms behind jobless recovery. Cost-cutting measures during economic downturns. In times of economic contraction, companies face declining revenue and must make difficult decisions to maintain profitability. Common strategies include raising prices. This strategy can be met with resistance, especially during recession. Gaining market share. Acquiring new customers typically demands investment and marketing expenditures, which can be hard to justify in a recession. Cutting costs. Nearly always the path of least resistance. Companies tend to reduce payroll by laying off workers, investing in automation, or outsourcing jobs to save money. The cost of labor constitutes a significant portion of operational expenses. Companies that lay off workers often opt for cost-saving technologies, leading to a workforce that does not recover in tandem with economic growth. The long-term impact on employment. Once the economy starts to recover, businesses may see increases in profits and revenue without the need to bring their workforce back to pre-recession levels. For instance, companies that have successfully implemented automation may find their operations more efficient, reducing the demand for human labor even as profits rise. Worker displacement. This situation can lead to worker displacement, where individuals who lost their jobs during the recession struggle to find new employment opportunities, especially if they lack the skills needed for jobs in a transforming economy. Those who are unemployed feel left behind as the stock market and GDP recover, further exacerbating income inequality and socioeconomic divides. A hypothetical example of jobless recovery. Consider the example of a manufacturing and distribution business facing a recession. 1. Initial state: the company operates with a workforce of 85 employees and generates $20 million in revenue. 2. Recession impact: revenues decline by 25%, compelling leadership to reduce operating costs aggressively. 3. Decisions made: the company invests in automation, purchasing robots to replace workers, and outsources administrative tasks, resulting in substantial savings and an initial layoff of 57 employees. 4. Recovery phase: over 5 years, revenues recover to pre-recession levels. However, the total workforce remains at around 28 employees, as the company realizes higher profitability through these changes. When this pattern occurs across the economy, it results in a jobless recovery, signifying that even though the economy has rebounded, jobs that were lost may not return. Broader implications of jobless recovery. Jobless recoveries raise significant concerns about the future of work and economic stability, such as inequality. Rising profits concentrated in fewer hands may heighten wealth inequality, affecting consumer spending and economic dynamics. Retraining programs. Governments may face pressure to develop retraining and reskilling programs to aid displaced workers and prepare them for new roles in a changing economy. Policy responses. Policymakers might need to evaluate economic stimulus packages that ensure job creation aligns more closely with GDP recovery. Conclusion. A jobless recovery is a complex economic situation that poses challenges not only for individuals who find themselves unemployed but also for policymakers and economists trying to understand and mitigate its implications. The interplay between automation, outsourcing, and economic growth highlights the importance of preparing both the economy and the workforce for future uncertainties. As economies continue to evolve, ongoing vigilance is required to avoid the pitfalls of economic growth that does not translate into job opportunities for all.